U.S. natural gas futures ticked higher on Thursday following a neutral to bullish EIA storage report that matched both expectations and the 5-year average at 76 billion cubic feet. Still, prices found additional support from the upcoming rollover to the November contract on Friday. Meanwhile, the outlook is far less encouraging for the bulls than it might appear, as the storage surplus continues to build. For the first time since January, inventories have surpassed last year's level by 22 billion cubic feet and stand 203 billion cubic feet above the 5-year average. Projections suggest the surplus will keep growing through October, potentially reaching 230 billion cubic feet by mid-month. Despite this clear bearish overhang, traders seem to be brushing it aside, betting instead on stronger LNG exports later this year. Supply-side pressures remain firmly in control. Lower 48 dry gas output was pegged at 108 billion cubic feet per day on Wednesday, up 5.6% from a year ago and hovering near record highs, while LNG feed gas demand eased slightly to 15.5 billion cubic feet per day. Onshore drilling also underscores resilient production, with 118 rigs active last week, just shy of a 2-year high. Adding to the longer-term headwinds, the EIA has lifted its 2025 production outlook to 106.6 billion cubic feet per day, reinforcing the bearish backdrop for prices. Weather forecasts provide only limited support. Analysts predict warmer conditions developing across the central and northern U.S. from late September into early October. Temperatures in the 80s and 90s across the south, along with lingering warmth in parts of the north, may extend cooling demand slightly longer than normal. However, overall national demand is expected to remain low to very low through September 30th. Capping any meaningful upside driven by weather alone. With Thursday's EIA report lacking a meaningful downside surprise, upside potential remains capped. A decisive break above $2.95 is needed to retest the $3 threshold, but strong supply, weak demand, and near-average storage builds keep the near-term bias tilted bearish. A failure to hold $2.85 would likely shift focus back to $2.80 support, with traders eyeing a short-term fade unless fresh bullish momentum emerges in the aftermath of the report. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.